On Point with Craig's Investment Partners.
The information provided here is general in nature and it's not financial advice. It doesn't take into account your situation, objectives, goals, or risk tolerance. All investments are subject to risk and none are guaranteed. Before you make any decisions, we recommend you contact an investment advisor. For more information about our services in that regard, or to view the Craig's Investment Partners Financial Advice Provider Disclosure Statement, please visit our website, which is craigsip.com. Welcome to On Point. I'm Mark Lister, Investment Director at Craig's Investment Partners, and I'll be talking about a range of topics including economics, portfolio strategy, investor education, and anything else that's happening out there in financial markets. The first 3 quarters of the calendar year are behind us, or nearly behind us. I'm recording this on Monday, the 29th of September, so a couple of trading days to go, but pretty much there. And investors have again been well rewarded for ignoring the noise and staying the course. It's been a very good period for investors this year, despite the volatility. World shares did fall 16.3% in the wake of President Trump's tariff announcements back in April. That was a very uncertain period. But if you had the resolve to stay calm, you will have enjoyed a 32.6% rebound from those lows. And that has seen world shares hit fresh highs, and they're up 16.9% compared to where they started the year. We've seen a few positive tailwinds that have become more evident in recent months. The global economy has proved resilient, earnings growth has come in stronger than expected, while concern over trade tensions has eased. Yes, US tariffs are higher than they were a year ago by quite a bit, but they aren't as bad as the worst case scenarios, and at least we know where we stand now. An agreement between the US and China, the world's 2 biggest economies, remains unresolved, with 2 consecutive 3-month extensions to the deadline so far. The latest of these will expire in the middle of November, so that is something to watch in the upcoming quarter. An undesirable outcome could derail the upbeat tone, so let's hope the recent reprieve reflects productive negotiations that are taking place behind the scenes. We also saw the world's biggest central bank cut interest rates for the first time this year. That was a real highlight of the third quarter. The Federal Reserve was on hold for 9 months, so one could argue that this latest move was the first cut of a new cycle. And if that is the case, it does bode well for the outlook, if history is any guide. We've seen 11 rate cutting cycles since 1980, and the S&P 500 was up in 8 of those, 8 out of 11, over the following 12 months, with an average return of that following 12 months after that first rate cut of 8.7%. Now, when a recession is avoided, and that's been the case in 5 out of those 11 occasions, the US market was up 100% of the time, over 6 months and 12 months, by an average of 10.8% and 17.4% for 6 months and 12 months. So every cycle is different. Every economic backdrop, market backdrop is unique, but history suggests that you do want to be invested when rates start coming down. That's especially so if the Fed is cutting into a relatively solid and stable environment where a slowdown might be imminent, but a recession is not, and many people believe that is the case today. It will be an eventful final 3 months of the year here in New Zealand too, and one that might even start with a 50 basis point OCR cut. The Reserve Bank meets next week, next Wednesday, and a cut of 0.25% looks to be assured. There is also a chance we see a larger cut if the bank chooses to act decisively and proactively. Financial market pricing is only ascribing about a 20% chance to that bigger 50 basis point cut, but 3 out of the 5 major banks, the big 4 and Kiwibank here in New Zealand, 3 of those 5 banks are picking, or at least recommending, a 50 basis point cut. So it is not out of the question. If they're right, we'll head into Christmas with mortgage rates a touch lower and hopefully a pickup in confidence and activity. For investors, there is every chance that markets finish the year in good spirits too. If the global economy remains resilient, if corporate earnings can continue to grow solidly, then share prices are likely to remain buoyant. We do have seasonality on our side this time of year, and this home stretch, the last 3 months of the year, is typically a positive period for global markets. Looking back to 1950, so over the last 75 years or so, the December quarter has been the strongest quarter of all for the S&P 500 index in the US. It's seen an average return of 4.5% and an 80% hit rate of positive returns. If that's the case again in 2025, let's hope some of that optimism finds its way down under to us here in New Zealand. Right, that's all for today, team. Thanks for listening. Enjoy your week.
For more insights, visit craigsip.com.